This is an analysis from Alpha Business Media.
Welcome back to the Deep Dive. Today, we are focusing our analytical lens on a huge strategic maneuver happening in Nepal's IT sector.
A really big one.
Yeah, the country has set an audacious, really specific goal. They want to hit $500 million in IT service exports by 2026.
And, this isn't just a political talking point. It's a profound strategic move.
Right. It signals this desired economic leap.
Yeah.
They're trying to diversify away from their historical reliance on things like remittances, tourism.
Foreign aid, yeah.
Yeah.
It's a direct push into the highly competitive global knowledge economy.
But what's really crucial to understand here, and our sources really underscore this, is that hitting that $500 million target, it's just not achievable through business as usual.
No, not at all. It demands a fundamental, I'd even say wrenching transition.
A transition in the structure of the entire sector.
Exactly. They have to pivot completely from a model that's based on labor arbitrage.
So basically just selling development hours to one built entirely on intellectual property, selling scalable, owned products.
And that pivot, that's our mission for this deep dive. We are going to dissect the mechanics, the economics, and the legal hurdles of that transition.
We have some great sources that detail the roadmap.
And they point to three, I think, really surprising insights for you. First, we're going to explore why corporate law, specifically registering a startup in Delaware of all places, is often 5 to 10 times more critical to a company's valuation than its actual product.
Then second, we'll look at how paying globally competitive salaries, and we're talking big numbers, up to $100,000 USD for a top developer in Kathmandu is not a cost burden. It's actually a high return investment.
There, finally, we're going to confront the hard truth. The single biggest barrier to hitting that $500 million target isn't talent, it's not technology, it's Nepal's own internal regulatory friction.
Specifically the Foreign Exchange Regulation Act.
But before we get into all those legal gymnastics, we really need to grasp the economics of this shift.
Absolutely.
Yeah.
For the last, 2 decades, the blueprint was just simple labor arbitrage.
Right. A Western firm hires a team in Kathmandu for a fraction of the cost.
A fraction of the cost of a team in, say, Seattle or London. And look, that model built the foundation of the tech ecosystem. It worked. But the problem is, it's restrictive. It's a business of linear scale.
So if you want to double your revenue, you have to, almost exactly double your headcount?
Precisely. And in that game, your margins are just constantly getting squeezed. You're competing on price against regional heavyweights.
Like Bangladesh, Vietnam.
The Philippines. They're all playing the same outsourcing game. The value in that model is it's transient. It's measured strictly in billable hours.
But wait, if the goal is $500 million, the math just doesn't work. Linear scaling can't get you there in a few years unless they, hire 50,000 developers tomorrow?
Exactly.
So isn't the massive investment needed for this pivot for building a product, isn't that a huge risk for an ecosystem that doesn't have deep local capital? How do they fund that jump?
That is the right question. And it's why the industry is doing what our sources call the great SaaS migration.
The pivot to software as a service.
Yes. You're right. The numbers demand nonlinearity. The only way to hit $500 million without dramatically increasing the entire nation's tech workforce is to stop selling time and start selling IP.
So instead of billing for a developer's time, the company builds one single asset, the software, and then sells access to it through recurring subscriptions all over the world.
The economics are just fundamentally superior. It totally transforms the risk profile. Yes, the initial investment is high, like you said, but the long-term profitability is unmatched.
Why? What's the key difference?
Because the cost of serving one more customer, the marginal cost, is basically zero. Once the product is built, scaling just means you're replicating a license key, not hiring another team of engineers.
Which unlocks that nonlinear, that exponential growth.
Exactly. And this allows for gross margins that can be over 80%. That is completely unheard of in the outsourcing world.
Okay, so let's put some numbers on that for everyone listening. The analogy in the source material really helps make this clear.
It's a great one.
An outsourcing firm, the old model, with 100 employees might generate, about $2 million in annual revenue. They're just selling labor.
And now compare that to a successful SaaS company. That company might have just 30 people, 30 highly specialized employees. But because they own a popular product, they can generate $10 million in annual recurring revenue, or ARR.
They're monetizing IP, not time.
It completely shifts your mindset. You stop thinking like a service provider and start acting like an asset manager.
It's the difference between being a contract mason paid by the hour to build someone else's house
A transient one-time payment.
and being the architect and the owner of a whole apartment complex that generates rent forever.
In perpetuity.
Yeah.
That's the engine for the $500 million goal.
Which brings us directly to the biggest hurdle. Once a Nepali SaaS company has this great product, the challenge isn't the code anymore. It's raising the capital to market it and scale it globally.
And this is the core question. Why can't they just raise money locally or attract international VCs while staying registered in Kathmandu?
And the answer is
A complete incompatibility of legal and financial frameworks. It creates a trust deficit. Global VCs, whether they're in the US or Europe or Singapore, they rely on a handful of standardized tools to mitigate their, frankly, extremely high risk.
Okay, tools like what, specifically? For anyone less familiar with startup financing, what are we talking about here?
We're talking about convertible notes, SAFEs, preferred stock, and crucially, employee stock ownership plans, or ESOPs.
Let's break one of those down. What's a SAFE?
A SAFE, a simple agreement for future equity, is kind of the bedrock of early-stage funding. An investor gives you cash today, but they only get equity later, usually at your next funding round. It's fast, it's simple.
And the ESOP, why is that so important?
The ESOP is critical for hiring. It lets you reward your first few employees with future ownership. You have to have that to recruit top talent without just burning all your cash on huge salaries right away.
And Nepal's domestic law. It just wasn't designed for this kind of thing.
Not at all. The mechanisms to issue these instruments are either super cumbersome or they just don't exist, but the absolute deal breaker for a VC is the exit.
The exit.
Getting their money out, repatriating profits, or returning capital after a company sells or has an IPO. It's described as an unpredictable, bureaucratic maze. That level of uncertainty is fatal for investors.
So the solution is this playbook that you hear about all the time, the Delaware Flip.
The Delaware Flip. It's the standard move for pretty much any founder with global ambitions in an emerging economy. It's a necessary maneuver.
So what happens? They just move the company?
They transfer their core IP and assets to a new U.S. parent company, a Delaware C Corporation. The original Nepali entity just becomes a wholly owned subsidiary. It's the development hub, but it's legally controlled from the U.S.
Okay, but why Delaware? It sounds so arbitrary for a Nepali company.
It is the opposite of arbitrary. It is the single most important legal step they can take. Delaware's Court of Chancery has the most developed, predictable corporate case law in the world.
It's about certainty.
Unmatched legal certainty. For a global VC, a Delaware C Corp is familiar. It's low friction. It's a trusted vehicle. It completely eliminates what they call sovereign risk.
Can you just break down sovereign risk in simple terms for us?
Sure. Sovereign risk is the fear that the government or the rules in a country will suddenly change and just wipe out your investment.
Okay.
So investors aren't just buying a product, they're betting on a stable legal environment. When you invest in a Delaware C Corp that just operates in Nepal, you remove that specific risk from the investment itself.
And that removal of risk, that's why the valuation difference is so staggering.
It is. The data in our sources really hammers this home.
Right.
Take a hypothetical company with $1 million in ARR.
Right.
As a Kathmandu entity, if they're lucky, they might get a valuation of $3 to $5 million, a 3 to 5 times multiple.
But after the Delaware Flip, the same company, same team, same product.
Suddenly, it commands a valuation of $10 to $20 million from international VCs, a 10 to 20 times multiple.
Wow.
Investors are paying a massive premium for legal predictability. The key insight here is that the company's legal passport is often 5 to 10 times more critical to its financial success than the code its developers write.
And that huge injection of capital, that's the fuel. It feeds directly into tackling that chronic problem of brain drain. For decades, the story was that senior engineers would always leave for higher salaries abroad.
Sydney, Berlin, Silicon Valley. It was seen as an unsolvable problem.
But now
This well-funded SaaS model, powered by that Delaware Flip capital, is launching a direct counteroffensive. They're weaponizing salaries, using cold, hard cash instead of just emotional appeals to stay home.
let's compare the costs, because this is where it gets really interesting. A senior software architect in San Francisco, their total cost is easily over $300,000 a year.
Easily. So the strategic move for the Nepali company is to offer $100,000 USD to a top-tier developer in Kathmandu. Globally, that is a bargain, 1/3 the cost.
But locally, that's a radical proposition.
Locally, $100K transforms your quality of life. It provides access to generational wealth, financial security. It changes everything.
And what's the cultural impact of that? I mean, what do the sources say about younger developers seeing this as a viable path now?
It's a massive psychological shift. When you factor in the crazy cost of living in Toronto or Sydney, a developer's net quality of life, earning $100 in Kathmandu, can often be better than what they'd get abroad.
So they get world-class pay, but they also get to stay connected to their family, their culture.
It completely eliminates that old binary choice.
Yeah.
Stay for modest pay or leave for high pay.
Now there's a third option. Stay in Nepal for world-class pay and build world-class IP.
Exactly. And this lets the ecosystem finally hold on to a critical mass of senior talent. And that creates what they call the brain circulation effect. These engineers don't just stay.
They reinvest.
They become angel investors, mentors, demanding customers. They raise the standards for the entire ecosystem. And crucially, the IP, the value, is created and captured and reinvested right there in Nepal, funding the next generation of companies.
So as we look towards that 2026 deadline, this $500 million target is really a barometer, isn't it? It's about Nepal's ability to adapt its internal systems to these fast-moving global opportunities.
Success hinges almost entirely on policy choices made today, not on some future technology.
Let's look at the two scenarios then. Scenario one, regulatory inertia. What happens if the current rules, especially that Foreign Exchange Regulation Act or FARA, stay the same?
Then progress is slow, and it's unfair. The Delaware Flip remains this complex, expensive, legally gray workaround. It's only accessible to the most determined, most well-connected founders.
You called FARA the villain here. What exactly does it do that's so bad for these startups?
It's a constant chokehold. First, modern software runs on foreign cloud services, AWS, Google Cloud. FARA makes it incredibly hard to send US dollars abroad to pay for those essential monthly bills. That's huge operational friction.
Okay.
Second, it makes transparently registering the foreign investment structures that VCs demand almost impossible. And third, and this is the killer, its restrictions on capital repatriation mean the exit path for investors is totally unpredictable.
And the result of all that friction?
Growth is just choked off. That friction is a tax on innovation. Hundreds of good startups will fail to scale, and the talent will leave. In that scenario, the $500 million target is almost certainly missed, throttled by domestic constraints, not international ones.
So what does the solution look like? The regulatory release valve, it sounds like it's not about subsidies.
No, it's strategic deregulation.
Okay.
The single most important change is to create a legal sandbox, or just a clear, streamlined process that formally sanctions a version of the Delaware Flip. They have to allow foreign holding structures, but only for raising foreign capital.
And combine that with simple rules for essential payments, like cloud services.
If they do that, they instantly legitimize the workaround, they democratize access to global capital, and they eliminate the uncertainty VCs hate.
And in that scenario two, the $500 million target suddenly becomes not just achievable, but maybe even conservative.
Because the whole ecosystem is suddenly plugged into the global financial grid.
And that's the hard truth takeaway here.
It is. This race to $500 million isn't a tech competition with India or a talent war with Bangladesh. The engineering talent is already world-class.
The true contest is internal.
It's a race between the dynamism of the tech sector and the inertia of a 20th century bureaucracy. The biggest competitor to Nepal's tech success is the friction inside its own government.
So that brings us back to our three takeaways. The only way to hit the target is through nonlinear SaaS growth. That SaaS needs capital, which demands a legal passport like the Delaware Flip. That, in turn, helps you retain top talent. But that whole engine only runs if domestic policy stops acting as a brake.
That's it. To succeed in the global knowledge economy, emerging markets have to solve their internal legal and capital hurdles first. You have to build structures that are compatible with how global investment actually works.
That is a powerful lesson for any emerging economy. If the success of this entire ambitious sector really hinges on streamlining regulation to accommodate global capital, well, what does that blueprint suggest for every other nation struggling with the same kind of friction? What happens when a country shifts its focus from labor protection to capital attraction? That is something for you to mull over. Thank you for joining us for this deep dive into Nepal's tech gambit.
We'll get you next time.